Hi there, this is Sean Broderick for UncommonWisdomDaily.com. The GFMS World Silver Survey for 2009 recently came out, and it's a very interesting read. In fact, it's such interesting reading that I put a link to it on my blog, which you can find by clicking on the button at the top of the Uncommon Wisdom Daily homepage. Some of the highlights of this report include that world silver supply increased 3% year over year, government selling is down 27% year over year, but the market is now in surplus. There is more supply than there is fabrication demand. The reason for that is when the global economy tanked in the fourth quarter, industrial demand for silver fell off a cliff. This sent the gold to silver ratio, for example, surging to 72. That's the highest it's been since 2004, and that's up from 50 in early 2007. But this just means that silver is historically cheap, and that should give it plenty of upside potential. But if the market is in surplus, why isn't silver below $10 an ounce? The reason is that silver investment demand is rising. And just like ETFs have powered up the price of gold, ETFs can also power up the price of silver. Take a look at this chart. You can see that the price of silver zigs and zags, but silver ETFs keep accumulating the metal steadily. That means when industrial demand comes back, the ETF demand could really send the price of silver soaring. Looking ahead, mine production for silver is expected to fall in 2009. Scrap supply will fall, government sales will fall, and overall supply will fall by about 2% this year. This is all according to GFMS. If it weren't for the drop in fabrication demand, prices would already be taking off. So it all comes down to investment demand. Let's look at the chart of the iShares Silver Trust, or SLV. You can see that the SLV topped out recently and is headed lower. On Monday, it pushed below its 10-day moving average. I'm using the SLV's 20-day moving average as my target. If the SLV bounces from its 20-day moving average, I think it could go back to test $20 and then break out. And if it can do that, then it can get to $24 pretty quickly, an upside of about $10 an ounce from here. Of course, there are other forces at work, the US dollar being a big one. Still, my subscribers should stay tuned. We'll be playing this move in red-hot commodity ETFs and red-hot global small caps. This is Sean Broderick for UncommonWisdomDaily.com. Thanks for tuning in.